Buyback and burn crypto strategy. What is it? Well, cryptocurrency faces great price volatility. Why? Well, the market and the asset is relatively new. So, in order to add stability to the price fluctuations, token issuers use buybacks and coin burns to tweak the supply-demand cycle. But we'll divide buyback and burning into two and begin with buyback. So removing an asset from circulation to adjust availability and value is called buyback, whereas burning occurs when tokens are delivered to an unusable wallet address, also known as a zero address or ether address, to remove them from circulation. But the address of the burn wallet is available to no one, and once crypto enters this wallet, it is lost forever. Miners are also allowed to burn cryptocurrency through a proof of burn, that is POB consensus mechanism. So these are two different terms popular in stock market as well. Publicly traded companies buy back their stocks to reduce the supply of shares available for trading. In crypto world, buyback limits the supply of the asset, which serves the purpose, right? That's what the purpose is. But burning impacts the currency and capital assets as well. Thus, token issuers use a combination of both as well, which is called buyback and burn. But we'll try to talk about this with our guests, and we'll explore how the combination really works. We have with us Ashish Anand, founder and CEO, Brew Finance. Also, Rohas Nagpal, Chief Blockchain Architect, Hybrid Finance Blockchain. A very warm welcome to both of you. Starting with you, Rohas. So we've given the explainer. If you can first give us the overview, or let's say your opinion on it.
Sure. So one of the most famous examples is Binance Coin or BNB. When in 2017 Binance came out with its white paper, they announced at that time that we are going to start with 200 million coins. Every quarter, we will buy back certain coins and keep burning them till we are left with only 100 million. So what they achieved by this burning is they are reducing the supply, and thereby logically the price should go up. So I am quite a fan of burning of coins. And another reason for this is, suppose a particular crypto project has a lot of funds, but it has no way to deploy the funds. So instead of just sitting on the money, they should go to the market and buy back their own tokens and keep it so that the cash can be deployed in a better financial manner. And that is the same strategy followed by some of the biggest companies in the world also, where excessive cash holdings are used to buy back the securities.
Sure, we'll also talk about.
I'm quite a fan of both these.
Okay, you are, and we'll also. I've read it in multiple sources about the combination of both these. We'll also touch upon that. But before that, I'll also like to go with Mr. Anand here. What is your overview and one example, if you can quote, or just like your opinion on buyback and burn? Mr. Anand, I believe you've muted yourself. If you can unmute.
Oh, sure. So, hi. So as we know that most of the crypto projects actually act like a supply of currency, right? And in that sense, they act as a central bank in themselves, where the central bank can reduce or increase the supply of the currency depending upon the mechanism set out into that particular cryptocurrency. So certainly burn is one way to reduce the supply, just so to ensure that if the token supply reduces, so upward effect on the prices will be seen. And the most famous example actually right now is EIP 1559 of Ethereum, which came last year. And since then, almost 3.5 crore to 4 crore rupee of Ethereum tokens are burnt every day. So, and that has actually helped, if you see that Ethereum prices to have actually outperformed Bitcoin even in the last year. Yeah.
Sure. Rohas, you also want to talk about combination of two. Of course, there are a lot of conventional companies, as you also mentioned, who have been using it in stock market as well. But they say a lot of token issuers are also using a combination of both these. How does that work?
So what we have to remember is, in a buyback, the founders of the project are buying the tokens and keeping it in their own wallets, but later they can always sell it.
Sure.
But in a burn, you are sending that to a burn address, and those tokens can never be recovered again. So in an ideal situation, you would do a buyback so that if you want to issue it back, you can just sell them again. I think in many projects, a buyback would make more sense. But in some projects like Binance, where they announced it, a burn makes more sense. So depending upon the realities of your crypto project, you would choose between these two. or maybe even try to use both. But the ultimate objective of both is the same, to reduce the supply and thereby increase the price.
But then there's also smart contracts. You know, when we enter the crypto world and we're talking about buyback and burn strategy, there's also a huge role of smart contracts. What does that do, Mr. Anand?
So, see, essentially, when we talk about any sort of action, we cannot depend upon a person to take that action in the crypto world. That action is taken in the crypto world by the smart contracts based upon the governance decision taken by the token holders typically. So, for example, when we are burning a token, we need to send this token to a wallet where from it can never be retrieved. And that work is typically done by the smart contracts, so that it will transfer those tokens from usable wallets to a non-usable wallet, and that way that supply can never enter the circulation once again. So that way you can think of it like when companies do buyback of their shares, so Companies Act has this provision that those shares which have been bought back must be taken out of the supply. So the same function is performed here by the smart contracts.
Yeah, exactly. I mean, let's say when we're talking about burning, some smart contracts also guarantee investors that the currency being sucked out will never really re-enter the system. Rohas, how important does that get?
It is. So when Ethereum does it, so in fact, when you create a token, one of the fields that you program into your smart contract is it burnable? Only if you say burnable, then in future can you actually do that. Now here we have to remember the only guarantee comes if it is burnt, not if it is bought back. Because in a buyback, it's in a private wallet, it can always come back. But in burning, every blockchain, when it is set up for the first time, automatically generates a burn address. And it looks very different from a typical conventional address. And any token sent to the burn address technologically can never be recovered again. That is like one of the fundamentals of the blockchain technology.
Right. Thank you so very much, both of you, for explaining buyback and burn in such a simple way. And of course, if one of our viewers, if any of you ever want to go back to it, you can always search it on social media platforms. Our explainers remain there.